Welcome to The Explainer. Today, we are diving deep into something called behavioral finance. We're going to pull back the curtain on the hidden psychological forces that are really driving your money decisions.
So let me ask you something right off the bat. When you make a financial decision, buying a stock, selling an investment, do you think you're acting like some kind of cold calculating machine? Or could your own mind be playing tricks on you? You see, for the longest time, the world of finance was built on one huge, simple idea: the rational investor. The core belief was that when it comes to money, all of us make perfectly logical, sensible decisions. And this really gets to the heart of it. On one hand, you have this ideal rational investor. They're always logical, they calculate everything, they're unemotional, and they have perfect self-control. But then there's the normal investor, which, let's be honest, is pretty much all of us. We use mental shortcuts, we're biased, we get emotional, and our self-control is, well, let's just say it's a bit more limited.
And it's right there, in that huge gap between the perfect theory and our messy reality, that a whole new way of thinking about finance was born.
The old theories looked great on paper, but they had one massive problem. They couldn't explain what was actually happening in the real world. They just couldn't make sense of huge market bubbles or sudden terrifying crashes and all sorts of other weirdness where prices just seemed to go haywire.
And that is where behavioral finance comes into the picture. It's this incredible field that mixes psychology with finance to figure out what's really going on. To put it simply, it's the study of how our own brains affect our financial choices and how all those individual choices add up to shape the entire market.
Now, this didn't happen overnight. For decades, the old-school finance models were king. But then, in the late 70s, some researchers started asking tough questions. The real game changer, though, came in 2002, when the field won a Nobel Prize. It was this huge validation of a pretty simple idea. How we think and feel is absolutely central to how economics work.
Okay, so if we aren't these perfectly rational robots, what is actually driving our decisions? Well, let's meet the culprits, our own cognitive biases.
Most of these decision-making mistakes can be sorted into four main buckets. First, you've got self-deception, which is basically when we lie to ourselves. Then there's heuristic simplification. That's just our brain's love of taking mental shortcuts. Of course, there's emotion, which can totally hijack our best plans. And finally, social influence, that powerful pull to just follow the crowd.
Let's look at a really big one: loss aversion. Here's the deal. Our brains are hardwired to hate losing way more than we enjoy winning. The sting of losing $100 feels so much worse than the joy of finding $100.
I mean, just look at how much bigger that pain bar is compared to the pleasure one. This one little bias has gigantic consequences for investors. It explains why people so often sell their winning stocks way too early just to lock in that little bit of pleasure, but then they'll hold on to their losing stocks forever just to avoid feeling the pain of admitting they made a mistake.
All right, next up is a true classic: overconfidence. This is our natural tendency to think we're smarter than we are, that we can predict the future better than we can, and that we have way more control over events than we actually do. And for investors, this often leads to things like trading way too often.
And believe me, this isn't just a personal problem that hurts your own portfolio. When you have millions and millions of investors all being overconfident at the exact same time, that can fuel enormous market swings, like speculative bubbles and just crazy, wild volatility. It's individual psychology scaling up to a global level.
And finally, let's talk about herding. This is that gut instinct to just follow the crowd. When we see tons of people buying something or selling something, our brain just assumes, wow, they must know something I don't. It's the financial version of thinking there's safety in numbers. So what's driving this? Well, it's a deeply human instinct. We have this powerful desire to belong to a group and a real fear of being the one left out. And during a market frenzy or a panic, that instinct can get so strong that it just completely steamrolls our own research and logical thinking.
So we've got all these little mental glitches. But so what? Why does any of this really matter? Well, because the impact goes way beyond our own bank accounts. This is where it gets really fascinating. These biases aren't just little personal quirks. When millions of investors are all feeling loss-averse at the same time, or they're all feeling overconfident at the same time, their collective actions can create these huge, sometimes even predictable waves that can move entire markets. And this idea flies directly in the face of a core belief in traditional finance, the efficient market hypothesis, which says prices always reflect all the known information. Behavioral finance says no way.
It shows us exactly why and how markets can be inefficient, because they're driven by us, by flawed, emotional, and sometimes beautifully irrational human beings.
Now, I know this might all sound a little discouraging, but here's the really good news. You can actually use this knowledge to your advantage. Let's talk about how to start outsmarting your own brain.
The single most powerful tool you have at your disposal is just awareness. Seriously, simply knowing that these biases exist, knowing that your brain is prone to loss aversion and overconfidence and hurting is the absolute best defense you can have.
So what does that actually look like? Well, it means focusing on hard facts, not all the chatter and noise from the market. It means being humble enough to admit when you're wrong and learn from it. It means actively fighting that urge to just follow the herd. But maybe the most powerful trick of all is this. Set clear, simple rules for your investments before you're in the heat of the moment. Decide on your buying and selling targets ahead of time, write them down, and then have the discipline to actually stick to them no matter what your emotions are screaming at you to do.
And that brings us to the end. So I'm going to leave you with a question to chew on. Now that you know about these hidden forces working inside your own mind, what's one financial habit, just one, that you're going to start to rethink?